Welcome to our video, where we'll explore the possibility of lowering your mortgage rate through a refinance rate buydown. It's a strategy that could potentially save you thousands, but there are several critical factors to consider before jumping into it. Here's what we'll cover in this video. First, we'll explain the basics of a rate buydown. Then, we'll delve into whether it's worth the investment. We'll also compare recasting to refinancing and discuss the limitations of rate reductions. Following this, we'll explore what happens if rates drop in the future, conduct a thorough cost analysis, and finally, seek expert recommendations. We'll conclude with key takeaways. Refinancing allows you to pay points, which are prepaid interest, to lower your interest rate. Each point basically costs 1% of your loan amount. For instance, if your loan is $250,000, 1 point will cost $2,500. This method can help bring down your monthly repayments by lowering the interest applied to your principal. Now, you might wonder if it's worth it to pursue a point buydown. The key here is to calculate the break-even point, which is essentially the amount of time it would take for your monthly savings from the lower rate to match the cost of the points you paid up front. Utilizing an online refinance calculator can be quite helpful for this analysis. Apart from refinancing, there's an alternative called recasting. This involves making a lump sum principal payment, for example, $30,000, which reduces your monthly payment without altering the interest rate. Recasting tends to be a more economical option compared to refinancing. It's crucial to discuss the limitations of rate reductions. It is unrealistic to expect a hefty rate drop by buying down points, as a reduction of 3% or more is seldom achieved. Generally, your goal should be a reduction between 0.5% to 1%. Keep in mind that attaining significant reductions requires a substantial investment. Let's test your understanding. What is the typical cost of 1 point in refinance rate buydown? Is it 1% of the loan amount, 2% of the loan amount, 0.5% of the loan amount, or 3% of the loan amount? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 1% of the loan amount. 1 point typically costs 1% of your loan amount, and it can significantly impact your interest rate. It's important to consider what happens if interest rates drop further in the future. You might decide to refinance once again at this lower rate. In such a situation, the points you initially paid might lose their value, since you'd be refinancing at even lower rates. Engaging in a thorough cost analysis is crucial. Be sure to factor in all refinancing costs, including closing costs, beyond just the points themselves. It's essential that you end up with a lower overall loan balance when you refinance. When involved in refinancing decisions, consulting with a mortgage broker is an invaluable step. Such professionals can provide personalized advice tailored to your unique circumstances and help you explore the best possible mortgage options. In conclusion, always evaluate the calculated break-even point and potential long-term savings before deciding on refinancing. Consider the cost-effectiveness of recasting against refinancing. Keep an eye on future interest rate movements, and consult mortgage professionals for tailored guidance. We hope you found this video on mortgage refinancing informative. Don't forget to like, share, and subscribe. And we'd love to hear your thoughts and experiences in the comments below. Thank you for watching.